Reaching $1 million in savings might seem impossible to some, especially if you're just beginning your financial journey. It doesn't have to be just a dream. But weirdly enough, a lot of people dream of that $1 million without actually making it a reality. Don't get me wrong, it's a great target to have. As they always say, the first million is the toughest to make. However, with good planning, regular savings, and wise investing, you'd be surprised what you can achieve. And it's also cool to call yourself a millionaire. So here are 6 simple steps to help you build a $1 million portfolio. But before we start the video, if you want to get tips and insights to help you reach financial success, then be sure to subscribe to our channel and hit that notification bell. Your support means a lot to us. Now let's get started. Number 1, create a solid financial plan. Before you embark on your journey to $1 million, it's essential to have a strong financial foundation in place. Begin by understanding your expenses and setting a clear budget. By determining your monthly earnings and then subtracting all bills and other costs, you'll have a clearer picture of your finances. If you find that there's not much left or you're in the negative, consider making some spending cuts. This way, you can divert more towards your investments. Building towards $1 million is a long process, and to ensure you don't dip into your investments prematurely, it's wise to have an emergency fund. Experts often suggest having 1 to 6 months worth of living expenses stored in a secure place, like a high-interest savings account. It's also crucial to clear any high-interest debts, especially from credit cards. With interest rates often exceeding 20%, they can drain your finances, especially when you compare it to the average 10% returns from the stock market. Lastly, while you don't need to be a financial guru to accumulate wealth, a basic understanding of investment principles and terminology can serve you well. This knowledge will equip you to make informed decisions and avoid potentially costly mistakes. As one gets older, it's wiser to be cautious since they might need the money sooner for retirement. As you invest, always monitor your net worth, the difference between your assets and debts. To gauge your financial growth, number 2, be consistent in saving and investing. Start saving and investing early and do it regularly. Beginning early gives your money more time to grow. This growth is due to compounding, which can greatly multiply your money over the years. For instance, consider Sarah, who starts investing at 25 with $5,000 and adds $300 every month. Now, Mike begins at 40 with $10,000 and adds $600 monthly. If both get an 8% return and plan to use their savings at 65, Sarah will have around $1.4 million, while Mike, even with larger investments, will have about $595,000. This shows how starting early, like Sarah did, can make a huge difference because of compounding. Consistently investing over time is often better for building wealth than risky short-term strategies. Dollar cost averaging is a method where you invest a set amount regularly, no matter how the market is performing. This helps lessen the effects of market ups and downs. When the market is low, you buy more shares for the same amount, and when it's high, you buy fewer. This can mean you spend less on average for each share, potentially increasing your returns in the long run. To save and invest regularly, consider these tips. Use automatic transfers for regular savings. Put money into your company's 401k, which directly takes from your paycheck, avoiding any temptation to use it. Boost your savings whenever you earn more or get unexpected money, like from an inheritance. Starting in your 20s, you might not have a lot to invest, but that's all right, said Ryan DeRusso, a financial advisor from New York. The key is to start investing whatever little you can, as soon as possible. There's a general idea that you need 25 times your yearly expenses to retire, but this can differ. Instead, begin by saving a portion, maybe 10%, of what you have now. As you grow older, you can better figure out how much you'll need for retirement. This way, you can adjust how much you save while you still have many working years ahead. Number 3, pick the right accounts. Choose the best savings accounts. By not using retirement accounts, you might lose out on tax benefits. There are mainly 2 types, 401ks and IRA. A 401k is linked to your job. Most workplaces offer it. Here, you save a part of your salary before taxes, which can lower your yearly taxable income. Plus, some companies give a matching amount, which is like getting extra money for free. On the other hand, an IRA is something you set up yourself at companies like Fidelity or Charles Schwab. It offers a wider range of investment choices than a 401k, but lets you save a smaller amount each year. Both 401ks and IRA have a special tax benefit. You won't pay taxes on the money you earn from your investments until you take it out during retirement. IRA and many 401ks offer a Roth choice. With a Roth IRA and Roth 401k, you put in money that's already been taxed, so you don't pay taxes when taking it out. Plus, there's no need to withdraw a set amount yearly after turning 73. This can be appealing if you want to avoid large taxes when retiring. However, retirement accounts aren't good for short-term aims, like buying a house or going on a special trip. This is because pulling money out of traditional 401ks or IRA before age 59 and a half can lead to extra taxes and fines. For short-term saving, think about using a high-interest savings account or money market account. If you've filled up your retirement savings and still want to invest or aim to retire early, a regular investment account could be right for you. Number 4, diversify your investments. Spread out your investments. A key idea in investing is diversification, which means not putting all your money in one place. Instead of buying shares in just one company, consider funds like ETFs or index funds. These funds invest in many companies at once, which can reduce risk. Plus, they usually have low fees. Dr. Jay Zigmont, a certified financial planner and founder of Child Free Wealth, suggests that investing can be simple. Just invest in ETF that cover the entire U.S. stock market and let it grow over time. There are also target date funds, which change your investments based on how close you are to retirement. Early on, they might invest more in stocks, but they'll shift to safer choices like bonds as retirement approaches. Once you're more confident in investing, you might look into buying shares in individual companies. Make sure to choose a mix from different industries or companies of various sizes to keep your investments diverse. Number 5, monitor and adjust your portfolio accordingly. Keep an eye on your investments. Getting to $1 million portfolio takes ongoing effort. Even though you shouldn't make quick decisions to buy or sell, it's good to check on your investments regularly. As time passes, you might need to make some changes, a process called rebalancing. This is when you change your investments a bit to keep them in line with your original goals. It ensures your investments aren't too risky and continue to grow as planned. Imagine you first decided to put 75% of your money in stocks and 25% in bonds. But over some time, because stocks often do better than bonds, you now have 85% in stocks and only 15% in bonds. To rebalance, you'd sell some stocks and buy more bonds to get back to your 75-25 split. If you're actively managing your investments, it's a good idea to do this rebalancing once or twice a year, always at the same time. Think of it as a regular financial checkup, much like doing yearly house cleaning. Before we reveal number 6, please subscribe to the channel and hit that like button if you've gotten any value so far. And for an added bonus, please check the links in the description to get more information about investing. Number 6, speak with a financial advisor. Talk to an expert. While you can start growing your investments by yourself, everyone's money situation is different. It's helpful to chat with a financial expert who can give advice suited just for you. They can guide you in making smart investment decisions and help with tax-saving strategies. Plus, if big things happen in your life like getting married, separating, or having a child, they can help adjust your financial plan. So, if you're thinking about finding a financial expert nearby, you can use tools or websites to find the right one for you. In short, starting and growing an investment to reach $1 million might seem tough, but experts believe it's possible if you start saving young and keep at it. By choosing a mix of investments and keeping an eye on them, you're paving your way to hitting that big number. But of course, having a financial advisor by your side is the best move. However, if you can't consult with a financial advisor right now, then we highly suggest you check out this video where we will reveal 5 incredible ways to save thousands on your taxes. Check it out here.